another one of the interesting webinars hosted by Kamco Invest. Today, we bring you insight into one of the lenses that we view on behalf of our investors when deciding, researching, and identifying opportunities in global equity markets. As an institution that manages around 13 billion of AUM across various asset classes and jurisdictions, we are constantly identifying areas of the market that fit the interests and objectives of our investors. More importantly, we provide access to such investment opportunities on a custom-tailored basis. My team and I oversee that initiative, and we thoroughly enjoy the engagement with our clients on thoughts and ideas and how we can together exploit the market and return. We as investment advisors seek certain attributes essential for any investment to fall under prior to making any recommendation to our clients, some of which include but are definitely not limited to the following: sustainability of an investment idea, the importance of a certain segment in the economy and the progress and evolution of the capital markets, multi-year trends that avail themselves because of an evolution of thought due to crisis or the anticipation of, social transformation across generations and demographics that influence trends and habits, providing companies opportunities for outsized and continuous financial gains. To summarize, we call this the pursuit of themes that guide us in identifying investment opportunities that are sustainable and able to survive the current and anticipated volatility in global markets. We explore how these themes are resilient to issues such as inflation and growth, or certainly the possibility of lack thereof. We try to determine if a possible theme gives our clients the belief and the resilience of their investment through tumultuous times, ironically reminiscent of the first month of 2022 as we've experienced over the last couple of weeks. We try to give them the confidence necessary to remain invested in the face of short-term threats in return for long-term value creation. We look for investments that drive a culture or social trend. It's quite clear and evident that transformation is constant. It is here and now. There is no better demonstration of transformation than the one experienced through the pandemic. Technology quickly stepped in to fill the gaps in areas of our lives that require us to keep moving in a productive manner. Technology is not simply isolated as a standalone sector anymore, but rather a driving factor for economies, markets, industries, and companies to continue their growth and remain competitive and functional in an ever-developing world. So without further ado, let's welcome our guest tonight, who will help shed a clear light on thematics as a strategy, more importantly, its merits going forward. Today, our guest is Richard Wiseman, Executive Director and Portfolio Manager at Goldman Sachs Asset Management, a firm overseeing more than $2 trillion in assets under supervision worldwide as of December 31st, 2021. Richard is a Senior Client Portfolio Manager for Goldman Sachs Asset Management's fundamental equity team, responsible for global developed market equities. Richard joined Goldman Sachs Asset Management in 2016 with 30 years of experience in global and European equities, including 25 years as a portfolio manager. Our engagement with Richard always revolved around thematic investing, as he is the portfolio manager of the Goldman Sachs Global Millennial Equity Portfolio. As stated above, demographics play an important role in our analysis and identification of potentially investable trends for our investors. Welcome, Richard.
Hello. Thank you, and I'm glad the technology is working properly.
It's always a challenge, isn't it? So let me just make a final check and make sure that we do have all our notes ready. So Richard, maybe we can start off with a brief introduction of what you do with your team and how you deliver value to your clients. What is it that you look for and how you look for it?
Okay, yeah. So I'll summarize the overall approach of the team that I work with within Goldman Sachs Asset Management. That's the fundamental equity team. This is the part of the division that manages strategies on a bottom-up basis, very, very mainly thinking about individual companies, their qualities, what the right time to buy them is, and then of course how to put them together into portfolios that meet our clients' needs. And we started from a more traditional position of sort of diverse portfolios, for global equities, multi-regional, multi-sector. But over the last few years, we have launched a number of more thematic portfolios, of which the Global Millennials Equity Strategy was the first. We've been managing that for 6 years now, almost to the day. And this reflects a growing awareness from our clients that there are certain parts of the investment opportunity which, due to significant secular change, mainly driven by technology, offer more attractive long-term opportunities for growth than some other areas. And our thematic portfolios have been designed to give the clients who understand that opportunity the right strategy in which to invest to take advantage of that. So everything we do is very bottom up. We're always thinking about individual companies. We want companies with high quality characteristics. And then of course we have to think about what the right price to pay for them is. But your introduction touched on some really key points here. We are thinking about secular growth in these thematic portfolios. We're thinking about areas of the economy, areas of the market that can be stronger for longer and more resilient through the ups and downs of the usual economic cycle. And this moment in time, where we are seeing a down in the markets because of worries about cyclicality, these are exactly the moments that I think clients need to take advantage of to buy into that long-term growth potential that we see in some of these areas.
Now, when we look at thematics, I mean, for us, we do have to follow multiple themes when we do search for investment opportunities. It could be the rise of the Asian consumer. It could be the transformation of old industries to new ones in Europe. It could be segments of the economy that will benefit from a low interest environment. The list goes on and on. The global commitment for infrastructure spending could be another theme, and it is another theme that we are pursuing. What specifically is the theme that you pursue on behalf of investors in your portfolio?
Yeah, I mean, you're absolutely right. There's no limit to what you can focus on in any particular thematic, and of course it doesn't have to be growth, but what we're most interested with our thematic opportunities are areas where we can see some economic force that will drive the revenues of certain companies on a much more sustainable basis. And in this particular strategy, our Global Millennials Equity Strategy, we are thinking about a demographic force, the power of the rising wealth of the world's largest generation, the millennials. I don't know whether we can access the slides that
absolutely
that we have, but if we can turn to the first one in the deck, I can highlight the point here. The global millennial generation is a generation of 2.3 billion individuals. You can see that on the graphic on the left. It's significantly larger as a generation to previous generations, as you can see. Now here, we're talking about the age group of people born between 1980 and the end of the millennium, 1999, year 2000, it doesn't really matter. Some people have a slightly different definition. So we're talking about people who were born really at the beginning of the digital age. And that's really important in determining how this generation spends its money. So it's a very big population of individuals, 2.3 billion. And remember that the vast majority of that number is accounted for by developing countries. So 2 billion of that 2.3 billion figure are millennials in developing nations, principally, of course, in China and India. So the emerging market opportunity is very important for us in all sorts of ways in this portfolio. But the key thing is shown on the right, and this is how I want to answer your question about what are we really focusing in on with this strategy. It is actually the financial power of millennials as consumers. You can see on the right 3 lines which represent the aggregate income of 3 generations. The millennials is the one that's going sharply upwards. And then the other 2 lines are the 2 previous generations, Gen X, which is still going up, but not so much. And then my generation, the baby boomers, which is now going down. Now, in my generation, if you're lucky, you're retiring. If you're unlucky, you're dying. And the aggregate income of my generation is going sharply down. Now, most people on this call, you probably think of the baby boomers, certainly in the West, as the wealthiest generation, because we were early in the property cycle, we had better pension provision and that sort of thing. And that is true. But that is not true of their income generating power. In that sense, it's going sharply down. So you can see this chart takes millennials' income to 2025, but for the next 15 years at least, they dominate the consumer landscape. And they are the most powerful consumers on the planet. So in this strategy, we're thinking about which companies benefit from that rising line of millennial financial power, and how can we take advantage of that? But there is a twist. There is a twist, because there are probably a lot of people on this call who are thinking to themselves, well, doesn't every generation get wealthier than the one before? Yeah, I mean, what's so unusual here? Why did we pick this generation to focus on? And the answer is because we believe, and all the evidence shows, that that money will be spent differently. Millennials spend their money differently for 2 key reasons. The first, of course, is technology. This is the first generation of digital natives. Most millennials have been brought up in a world where the smartphone is at the center of everything they do. And most of the big technology companies that we're all familiar with only began at the beginning of the millennials' lives. You know, my children are millennials. My twin daughters were born the year that Alphabet began, and my son was born the year that Amazon began. You know, so actually, millennials have grown up hand in hand with these companies, using their services, catalyzing their growth. To the point where eventually everybody adopts those ways of doing things because it's better. And of course, the pandemic showed us how much online activity increased when we were in global lockdown. So technology is one reason why millennials spend differently. Different spending creates disruption. Disruption creates significant opportunity for investors. But the other reason that millennials spend differently is because they have increasingly shown, as they have got older, that they have different priorities in life, different lifestyle values. And a lot of this is based around the environment, climate change, sustainability, all those sorts of issues. So we don't just think about technology in this strategy, we think about lifestyle issues such as healthy eating, renewable power, naturally sourced ingredients, recyclable packaging, very different types of companies. And just finally, the interesting thing here is that we need to remember that millennials are getting older. I sometimes offend people by pointing out that the oldest millennials are no longer young. Millennials are moving into their 40s, and with that aging comes greater influence in society.
Decision makers, so on and so forth.
Exactly, and most importantly, perhaps, voters. You know, all millennials are now people who have the vote, and they have become much more influential across the world, and they are beginning to shape how the world changes. And there's no question that their greater concern about sustainability, net zero, any of that that piece, their greater concern is without doubt a major source of pressure for governments and companies to change. And we want to capture some of that as well.
Now we've identified millennials as being the overall theme in that sphere. How do we break up that theme into sub-themes or sub-ideas that we can pursue in order to construct a portfolio? There must be many ideas that we can pursue. As we started with the introduction, it's no longer only technology, but technology has become more and more participating in other sectors and industries as well, being critical to them as well.
Yeah, and this is where building a portfolio around a theme begins to focus you in on certain areas rather than others. Everybody on this call will be aware that portfolios that are heavily focused on growth and technology have had a very tough time recently. That's a function of two things. Firstly, those areas of the market have been weak, but other areas of the market have been strong. So in focusing on certain areas, there are two parts to the equation: what you own and what you don't own. But the rule with a thematic portfolio must always be to stay true to the companies that are relevant to your theme. So the companies that are relevant to this theme are focused in those two areas that I mentioned: technology and lifestyle. And because that's where the real difference in spending patterns is changing. We're not really, millennials use lots of services and goods and so on that everybody else uses, and they're not that interesting to us because there's no real change, there's no real disruption. The potential returns we might be able to derive from those areas will not be unusual. But where millennial spending is changing how we do things, then that's where we want to focus. So within technology and lifestyle, we drill down to certain sub-themes where we can really see the impact of millennial spending. And when we think about companies that we invest in, we need to be sure that millennial spending is the key driver of their future growth. Now, so this is the perfect slide to illustrate what I'm saying. We've got two parts to this aspect of different spending: technology-enabled consumption and lifestyle and values. Two very different opportunity sets, but the common denominator is the power of millennial money to identify businesses that will disrupt traditional ways of spending. And you can see on this slide some of the sub-themes that we can drill down into. Now, these are not fixed, and they have different weights in the portfolio at the moment, because some things are more relevant than others. But it gives you a feel for the sorts of things that we need to focus on to extract the best possible opportunities from this thematic.
Can we drill down further to this? Now would be my next question.
We can, yes, and the interesting thing here is that some of these areas offer us more opportunity than others. So when I say we want companies where we feel that the millennial spending is really driving that future opportunity, we're talking about companies that have at least 50% of their revenues derived from millennial spending now, okay, and in many cases more than 70%.
Would that skip out companies? So maybe we can use an example at this time. So we all know Google and Facebook, for instance. Let's use those as an example. Maybe my guess is wrong, but I don't believe that 50% of Google's revenue is derived from millennials. Does that make it fair game, or is it quickly dismissed away from your filter?
No, we actually think that in many of the areas that Google operates, younger people are driving that growth. Now, there's no question that older generations have completely adopted the use of Google and the various things that it does, but we still think the key driver of that is the Millennial Generation, and even the generation coming up behind Gen Z. So we would have Alphabet, Google as a valid company in this opportunity set, but it's not at the high end of exposure. Now you mentioned Facebook. That's an interesting example, because
Great.
social media has obviously evolved over the last 10 or 20 years, driven by the use of younger people. And Facebook was clearly the leading company in that area. But we know now that so many other people, other generations have adopted the use of Facebook, that actually younger people are not really the dominant driver of Facebook anymore. And so in this portfolio, we actually have a greater exposure to other social media companies like Snap, where you can see from their data that it's much more dominated by younger people, both millennials and Gen Z, than older generations. So it's interesting how even over a relatively short period of time for a company like Facebook, you can see that demographic influence changing how they do things. And of course, when Facebook changed its name to Meta Platforms, they explicitly made clear that they want to make themselves more relevant to younger people in the future. And so it's interesting that companies are actually trying to adapt to demographic pressures quite explicitly. But the other point I wanted to make is that, in some areas, we know that younger people dominate. So take something like gaming. We know that the millennials and younger people, are predominantly the generations that are involved in gaming. In China, for instance, 600 million people play games on their mobile phones. 600 million. Well, the millennial generation is about 420 million in China. So you can be pretty sure that almost every millennial in China is gaming. So there are a lot of gaming companies that we can think about for this strategy. We own a few, but obviously not all. But we know that it's a key driver for those businesses. But if you take another area like food and drink, what is millennial about food and drink? We all need it, so we're all spending on it. And actually, in an area like food and drink, we have to be much more specific about what we can own. And within food and drink, for instance, we're thinking about meat substitutes. We're thinking about sustainably sourced products. Which companies are truly doing what they do in a sustainable way, and that would include companies that focus on recyclable packaging and those sorts of issues. So in some areas, our focus is very specific. Even if it's a big sector, we'll only be looking at a certain part of it, and so the opportunities will be fewer. But in this portfolio, which is a focused strategy, we own just 45 holdings. We only need a few in those areas to make a significant difference to our performance.
How do you diversify 45 names or a concentrated portfolio? How is that achieved? What sectors are you in? Where do you see your focus or your concentration being?
Yeah, so there are two ways of thinking about it. Firstly, as I said, our culture within Goldman Sachs Asset Management and the fundamental equity division is very bottom up. It's all about individual companies, and we're not going to let our top-down thematic override our bottom-up principles. So even if there's an area that we know is clearly driven by millennial spending, if we can't find the right companies at the right price, we're not going to be there. Yeah, so it's very important to remember we don't let the top down override our bottom up principles. And an example of that sort of situation would be the likes of Uber and Lyft and car sharing. There are opportunities to invest in those companies for this strategy. They're clearly areas that younger people have caused to become as successful as they are. But actually, we haven't yet been able to find a company that we like in terms of valuation, and we haven't invested in those areas. But we think there are, when we launched this strategy back in 2016, we developed our own proprietary universe of companies that we believed were linked to millennial spending. It's about 500 companies, and it's spread right across the industrial landscape where we find companies relevant to millennial spending. As I said, it might be a lot more companies in some areas like gaming or social media, but we can still find opportunities across most industries because of this unusual spread that technology and lifestyle offers us. So the way we diversify is to make sure that we avoid concentration risk across different sub-themes, and we can also look at that picture in terms of sectors. This is a good way of looking at how we diversify. Here are some of the sub-themes that were on the previous page, and you can see that we're spread across them. We've obviously got better exposure in some areas than others because that reflects where we can find more companies that fit our theme and are at the right price. But you can see that we're very well diversified. And we look at the correlations across them when we build the portfolio, to make sure that our factor risk is also controlled at the portfolio level as well. And these sub themes can include some really very different companies. For instance, if you take sustainable living is the area where we own a number of companies that are particularly important in environmental issues and helping us to get to net zero. In that area, we own 2 renewable energy companies because we know from surveys that when millennials purchase a property, their preference is to power it with renewable energy. So they're going to be a key driver for how we solve domestic heating problems going forward, because they want that to be part of how they live. But in that space as well, we own a company that produces naturally sourced ingredients for food, both for people and livestock in agriculture, and also a company that is a leading part of the recyclable packaging movement that is in its own way disrupting so many consumer companies today. So we keep diversified by thinking about the portfolio in this way, having a very broad range of companies that are not correlated across these themes. And the other way of thinking about it, I think we can show on the next slide, which is a picture of the portfolio in a more traditional view, looking at the sectors in our benchmark and our geographic distribution as well. So you can see in some sectors we're very heavy, we're very focused, because those sectors are particularly relevant to our thematic today. So communication services contains all those gaming, social media, online dating, companies that really reflect the epicenter of millennial spending today, and also consumer discretionary. That's where we own companies that provide some of the products that millennials particularly like luxury goods, for instance. And we're very underweight other areas. So we're very underweight information technology because we don't own some of the big tech companies. We don't own Apple or Microsoft or Tesla or Netflix.
Why not?
Well,
why not?
It's not because we don't like what they do. They're great companies, it's not always because we don't like the valuation. I think there have been times when you could argue that Apple was not an expensive company. The reason we tend not to own the big companies is that we prefer to find more companies that are more linked to our theme, to the spending of millennials, that are a bit more focused in that way, and which are slightly earlier stage. So we think there might be a longer runway for growth from here. With a company like Apple, obviously it's done amazingly well, a great set of numbers recently, the shares are continuing to do well. We like the markets that Apple serves, and we have exposure to those markets through
Do you look
different
for their
types of companies.
suppliers? Do you look for Apple's suppliers per se?
That can be part of it, yeah. And again, that's quite a useful reflection of our mindset, because we prefer to invest through more diversified companies if we can. So for instance, in the Apple supply chain, it's not just about maybe semiconductors and the chips they use and the companies that provide them. It can be companies that provide components for the manufacturing process of smartphones, for instance. And our thinking there is that, you know, if Apple had a problem, if the next iPhone was a failure, then the companies we own aren't just linked to Apple. You know, they serve all smartphone providers.
Such as
what, the company we own, or so we own a company, for instance, that makes the lasers in robotic arms. So they're sort of like the eyes of the robot, and these components are used in smartphone manufacturing, but also the manufacturing of other devices, which means that we have exposure to sort of multiple sources of growth through this component technology, and we tend to like to do that if we can. I'll give you another example: electric vehicles. We've been big believers in the growth of electric vehicles for many years. I know now it seems obvious, but 5-6 years ago when we launched, actually talking about electric vehicles was a new conversation for a lot of our clients. You know, it's amazing. Yeah. It's amazing how quickly we've all come to understand the potential for this market. But back in 2016, we didn't own any company that made electric vehicles, but we owned a number of companies that made the components. So whether it was precision motors, electric motors that populate the power chain of an electric vehicle, or whether it was a company that made the sensors that a lot of electric, and then of course autonomous vehicles will have. We played it that way because we didn't know, and I don't think we still know, who's going to win the electric vehicle race. I mean, Tesla's obviously been terrific, but the other big manufacturers are drawing in on them, and we don't know who's going to win that race ultimately. But we do know that they're all going to need these components. So we have often preferred to play new technologies in a more diversified way. Not always, but often.
On that point, we are experiencing global economic challenges, most notably inflation and logistics, and among others. So, how do you overcome these challenges? Do you simply see this as an opportunity versus a headwind? How do you overcome them? How do you capitalize on them?
Yeah. And you know, really, this is the key question.
And it revolves around semiconductors, and you touched on it briefly. We've all seen semiconductors in the news right now being the critical issue, the driving factor with regards to pricing of vehicles, whether they're electric or conventional gas guzzlers.
Yeah, and semiconductors is a good illustration of how dangerous it is to generalize about things at the moment, because we're worrying about inflation. We've got supply chain bottlenecks because of the pandemic. and that applies to semiconductors. But semiconductor manufacturers have done incredibly well because of it. Yeah, so there's often a flip side to the negative. There's always an opportunity that we can be thinking about. But let me answer your question in a couple of ways, because I think I would imagine for everybody on the call, the key question in your mind is the pressure we're seeing in some of the areas of the market, growth, innovation, and so on, is that going to continue, or is this an opportunity? Now, let's think about it at a high level. For a thematic investor, when the market goes against the sorts of companies you own, when you get some sort of short-term cyclical influence that changes the price of many of the companies that you're interested in, that is your opportunity. Okay. We manage these strategies because we strongly believe in that long-term opportunity. We want to own companies that, as a result of that long-term strong opportunity, they will be less vulnerable to the economic cycle than other companies. They will be less cyclical. They will have secular strength. It doesn't mean their share prices won't go down when the market panics about interest rate rises. But it does mean that operationally, fundamentally, these businesses should be less vulnerable to the implications of these cyclical economic factors than other businesses. And if you believe that, then you should be buying into this sort of short-term cyclical weakness. I don't know whether it's today or next week or next month. That's not the point. The point is, if you believe what we believe, that companies that play into a long-term secular dynamic with a very, very strong economic force behind it, then you should be prepared to buy in and hold that through the piece. Now,
will you look for opportunities in your portfolio, or will this be an opportunity to look outside of your portfolio to add new names?
It's both. It's both. Now, don't get me wrong. I'm not being dismissive or complacent about significant changes in the economic landscape. We do have inflation. We have got rising rates. They're much higher than anyone thought 12 months ago, and it's quite conceivable they'll be higher in 12 months' time than they are now. Yeah, no one knows. No one forecast it, and we have to bear that in mind. So we have to go back to the portfolio. We have to think about all the companies we currently own. Will inflation be a problem for them? We actually think in many cases it won't be, because if we're investing in the right sorts of companies, they should have pricing power. You know, we own Louis Vuitton, LVMH in this portfolio. It's quite a new holding. They had a terrific set of numbers last week. The shares were strong. You know, this is a company with pricing power. There is money out there to be spent, and it's heading in those sorts of directions. So, and then interest rates. We own, everyone's been talking about non-profitable companies. What's the implication of rising rates for them? Now, I understand why non-profitable companies get a multiple compression in these times, but nearly all the companies in our portfolio, even if they don't have earnings, have positive EBITDA, positive cash flow. And it's very unlikely that rate rises up to, let's say, 2% is going to affect their interest charge to any extent, or their ability to fund their business.
This is where we were in 2019. So whatever we're doing right now for the very near future, we're just going back to where we were in terms of central bank rates.
Yeah, well, exactly. Now, look, it's a valid worry because rates could go higher. And there are clearly some companies that have done well because we've been in a very low interest rate environment and funding has been easy. But in this strategy, we only own companies where we can see how they fund their own growth. And we would not be invested in companies that would be impaired by a rise in rates to, 3% or whatever the figure is. But we have to do that work. To answer your question, when we get these changes in macroeconomic issues that affect companies. We have to go back to each company and our investment thesis. We have to stress test it, and we have to make sure that we're still comfortable. And actually, during the last 2 months, when this has all been going on in the market, we have made basically no changes. In recent days, we've added a new holding, in China, in fact. And so to answer the other part of your question, we think we are now in a period where we're seeing significant dislocation between the price of many companies and that long-term potential. I would urge everybody on this call to think about the underlying fundamentals of some of these businesses. Some companies have gone down a lot in terms of share price. Are they doing worse as businesses? They are not. Most of them are doing much better because we're all doing more things online, even if it's not as much as 2020. The long-term prospects for many of these businesses are improving as their share prices are declining. That is a decoupling of price with fundamentals that has to be interesting to us within this strategy and to you in terms of an opportunity to buy in.
Now, let me ask this question, and I believe you answered it. So the flip side of my earlier question, what has changed in your portfolio? How has your portfolio been influenced with the recent economic changes in terms of dismissing certain names within your portfolio? I think you've answered it. You said you've added names and not removed any names. But do you believe that you will be removing names because of changing dynamics in the global economy or in the markets?
We're unlikely to change anything in the portfolio because of what is happening now. Everything we own, there's a long-term investment thesis based on a long runway for growth. So there's certainly nothing that we own that is going to be impaired by what we see going on in the market at the moment, or even the economy. But the market may give us opportunities to buy into some companies at a very attractive price. And we may fund that by removing positions from the portfolio where the upside is less attractive. So we might be in a position to switch from one company to another, but that will be dependent on the market providing us with that sort of pricing opportunity. In China, we added a new name there. We actually funded it from taking a little bit of money out of existing China holdings. You can see on this page on the screen that we have a 23% exposure in the strategy to emerging markets. Of that, China is 9%. So China's important to our to the strategy. It's been important to our historic outperformance, but it's very controlled. Clearly it is a very volatile market, and it has issues that we've seen over the last 12 months that make it have a very different sort of risk profile to others, and we have to control that. So we added a new name, but we took it from within the existing weighting, and we've kept the risk exposure to that area the same.
Now, I have a question. I don't know how to put it lightly, but we've seen magnanimous changes in focuses in capital markets, or at least with the younger generation. So since physical properties are getting more expensive, we're now seeing more and more people buying properties in the Metaverse. Does that influence? Is that direction, the millennial direction towards the non-physical or the virtual, seem attractive to you at this point? And
well, yes, yeah. So I know to some extent you're baiting me here, because I think that the Metaverse is something we have to be very, very careful about, because I don't know about people on this call, but I didn't even know the word 6 months ago. Yeah, so it's yeah, and all of a sudden, everybody is thinking about it. And in fact, this particular slide that I chose to illustrate the metaverse was one of hundreds that you can find if you Google it to try to work out what it means. For me, the metaverse seems to be a natural extension of the way that things have developed over the last few years. It's basically just the increasing influence of digitalization in our lives. And I liked this way of thinking about it because if you go through the list of, on the right, it's basically everything. Yeah, you can put everything in the metaverse. Every fund out there, every strategy out there with some exposure to technology can say it has a link to the metaverse. 5G, Wi-Fi, and so that is true. That so let's not get carried away about the metaverse being some incredibly different opportunity. It's a natural extension of the direction we've been going as a society for the last 2 decades. And that means that probably the most opportunity will be for companies we already own that have the opportunity to develop in that way. So I don't think we need to be looking for a whole new bunch of different companies. I think we need to think about how it can benefit what we already own. But there is one particular area that I think is very relevant to this strategy, and that's why I included this slide, and that is the outer circle of the metaverse on this page: experience. Now, think about the 2 parts of this strategy that we invest in: technology and non-technology, lifestyle. Lifestyle is largely about experiences, whether it's gaming, whether it's travel, those sorts of things. We have 2 companies that are leaders in live entertainment, putting on concerts and shows and so on. A very important part of what millennials like to spend their money on when pandemics don't stop it happening. So actually, our 2 parts of the portfolio, technology and non-technology, is exactly that collision of the physical and the digital world that most people understand is the metaverse at the moment. It's that outer ring. It's bringing physical experiences into the virtual world. You mentioned buying property in the metaverse. That's a physical experience that we're now taking into a virtual world. It obviously began with gaming. And we have plenty of exposure to that in this strategy, but it's also beginning to affect some of the other physical companies in the portfolio, particularly in retailing. So we own a company called Ulta Beauty. It's a cosmetics company, and it particularly appeals to not just millennials, but Gen Z. And they are beginning to enable their customers to experience their cosmetics virtually. So they're taking their customers into the metaverse through cosmetics. What would you look like if you apply this lipstick or this foundation or this eyelash? And that is an incredible opportunity for some of these companies that can do it. So I actually think the metaverse, whatever it turns out to be, is very relevant to this strategy, because we have a lot of that outer ring which can make a big difference to companies that can take advantage of it.
Now, pardon my ignorance, but yes, how can we look at it from the eyes of hardware versus software? So I understand the virtual is mostly software, but what is the facilitator in terms of hardware? Do you look at that, or do you dismiss that?
No, you've got on this page, you've got all sorts of references to different technologies, hardware, software, and so on that will facilitate this. I'm not aware that there are any, apart from things like wearables, the sort of eyepieces or smart glasses that you might wear if you're doing something in augmented reality or virtual reality. I'm not aware of particularly specific metaverse hardware opportunities. I may be wrong, but we do know that companies like NVIDIA, which make game processing units, we know that their technology will almost certainly be at the core of what facilitates a move into the metaverse through AR and VR. We own NVIDIA in this strategy because it's actually that the power of the chips that it provides is going to drive a lot of the cutting edge innovation that we talk about now, whether it's crypto, whether it's AI, machine learning. This all needs greater power, and NVIDIA is incredibly well placed to benefit from that. And that obviously includes the metaverse.
And in terms of infrastructure spending, we're seeing trillions being committed globally with regards to infrastructure spending. And I think the estimates with regards to the cost of net zero being 9 to 10 trillion over the course of the next decade, two, or whatever it takes. How do you exploit opportunities in that? No, I know you've linked it somehow earlier in the conversation, but how do you bring it in to millennial needs?
Yeah, well, the sort of capex that you've highlighted that has been associated with net zero is really interesting, because if you think about that slide we looked at earlier that showed the rising line of millennial income, in our thematic portfolios, we need to be able to understand the economic force behind what we're doing. And we talked about, we've touched on the current environment, secular, cyclical. The fact is that the spending power of millennials will go up. It is an irrefutable fact. It may not be in a straight line, but it will go up. And we take reassurance from that fact in order to support what we do in this thematic. But we have to be able to link that spending to the revenues of individual companies. And that's why we spend so much time talking to companies. What do millennials mean to you? How have you adapted to how they spend? Where is Gen Z in your thinking? We need to make that link. Otherwise, this is just a strategy with lots of exciting buzzwords and trendy things and lots of current fads. We need to get that link between the power of the thematic, the economic force, and the revenues of the companies that we own today. And in the challenge to get to net zero, the sorts of numbers that you have cited in terms of capex from companies, from governments to try to achieve that is really interesting to us, because that gives us quantifiable financial power that we can then think about translating to company revenues. And for us, we know that millennials will want to spend their money in a way that aligns with their values, particularly around the environment. And so we can see that increasing capex in the sort of sustainability space influencing many of the companies that we already think about in the context of millennial spending. And I'll give you an example. If I have time. Let's talk about methane. Right, let's talk about methane. Methane is the second most important greenhouse gas after carbon dioxide. There's much less of it in the atmosphere, but it's much more toxic. About 30 times more toxic than CO2. It doesn't stick around quite as long, but it does a lot of damage when it's there. And everyone on this call will probably remember that about the only sort of tangible policy that came out of COP26 was a commitment to reduce methane levels in the world. Now, if you're going to commit to reduce methane levels, you have to tackle two industries in particular, because methane is predominantly produced in two ways by what we do. Methane occurs naturally, of course. It's mainly produced in swamps and bogs. If you go to a swamp, it's a bit smelly. That's methane. Yeah. So it's a natural gas, but mankind increases the amount of methane in the atmosphere in two main ways. The first is as a byproduct of extracting gas from the earth. So that's an issue for the energy sector. But the other way, almost as impactful, is agriculture. Methane is produced by livestock, particularly cattle. When cows burp, they burp a lot of methane. They have several stomachs, as I'm sure you all know, and as the food that they eat ferments in those four stomachs, they produce methane gas. So you cannot tackle the problem of methane gas without tackling the problem of how to stop cows burping gas. A few years ago, we were talking about this, and clients found it quite amusing. You know, you don't often go to a meeting on a global equity product and talk about burping cows. So that's interesting. But we owned a company that was trying to solve this problem. It's a Dutch company. It's called DSM. It makes naturally sourced ingredients for food, both for people and livestock. And it was trying to address this issue of methane produced from livestock. And last year, the result of that effort was seen because they brought a product to the market that does just that. It reduces the methane from cows. You add it to their feed, and it suppresses methane production significantly, between 50 and 90%, depending
Wow.
on how you mix it. Now, here's the interesting thing. This product has just got a license in Brazil. Brazil has the world's largest herd of cattle. It's about 220 million cows, mainly used actually in the meat industry as well as dairy. Here's an interesting stat. This is why I'm telling you this story. If 1 million cows use this product, it will be the carbon offset equivalent of planting 40 million trees. So here is a product which has both great return potential for the company and for us as investors if it gains traction around the world, and has significant impact on net zero. I suspect, we think, that younger people, millennials, Gen Z, will start demanding that products are created using these sorts of opportunities in order to achieve net zero. So it's a long story about methane, but it illustrates how we can link the capex that will be spent to try to address the issue of methane to the revenues of the companies that we can invest in this portfolio. It's a very good example of how we can take that economic force and understand how it benefits us as an investor in an individual company.
I just have one final question, and it does not have a negative connotation or anything. Maybe you can give us examples of what went wrong over the last year or two, or choose a period where you believe you've learned a lesson in the markets and you've had to abandon an idea.
Well, yeah, that's an interesting question. Obviously, you know, in this strategy, we have exposure to a number of companies that have been under significant pressure in share price terms. And despite, you know, our long-term numbers are terrific, and I think against some of our best competition, we've done well, even if it's been tough. But the most important thing, I think, the most important way to address your question is to focus on any area where the fundamentals have been challenged, because I still maintain that what we're seeing at the moment is a decoupling of share prices in many cases from the operating fundamentals of the businesses. The fundamentals of the companies we own are not deteriorating, and so falling share prices is ultimately going to be an opportunity. But there has been an area in the portfolio that's been difficult because something has changed in a way that we have to give significant thought to. And that was the change in Apple's privacy laws. IDFA, Identifiers for Advertisers. For those on the call that aren't familiar with this, this was a change that meant that it's much harder for advertisers on services that use Apple's software, much harder for advertisers to target the right individuals because you can opt into anonymity. And therefore an advertiser won't know whether it's actually spending its money wisely or not, because it can't be certain anymore that that money is targeting. And this had a significant impact on some social media companies, one in particular that we own, I mentioned it earlier, Snap, and it also had a significant short-term impact on some e-commerce providers where advertising was part of the mix and so on. You know, this was a meaningful change in certainly the short-term revenue opportunity for some of these businesses, and it did have an impact on the fundamentals of the business. And so, and those areas of the portfolio were weak and led to underperformance. And so we are trying to figure out now to what extent the companies we own can get round this, can find a solution, and to what extent those advertisers will come back. You know, these are very innovative businesses. The key fundamentals of those businesses remain strong. Subscriber growth is strong. User time is strong. They're doing what is still very attractive to advertisers, but you've got this issue that has to be overcome in the short term. So we haven't made any changes as a result of that yet, because we're not entirely clear how it plays out. We think a solution will be found. We're obviously engaging with these companies to try to figure out how they're thinking about it, but it has been a challenge for some of the companies in the portfolio, and we're still working through that.
Well, back to the point about methane. As long as the Earth survives till I'm dead, I'm not giving up my stakes whatsoever.
But you won't have to. You won't have to, because if we can eat steaks made from cows that took this product and didn't emit methane, then everyone's happy. Except vegetarians.
We have a couple of questions here, Richard. Maybe we could spend 1 minute, but quickly go through them so we don't lose interest from our audience. I don't know if you could see them popping up on your screen.
I can't actually, no.
Okay, so the first one is from Stefano Alaisa. It says, sir, 10 shares in the S&P 500, an example 2%, account for a market cap of 10 trillion. That is 25% of the total market cap of the S&P 500 of about 40 trillion. And so these companies have a market cap larger than twice the GDP of Japan, to say the least. So how bad is it?
How bad is it? Well, yeah. So it depends. Whether, I'm not sure whether you're saying that's a good thing or a bad thing.
Well, where are we going? Or you do not? From me, I understand your strategy. You don't look at these dynamics, but look at the thematics from a bottom-up perspective. Yeah.
Well, so clearly there are a small number of companies dominate benchmarks. They have done for some while. For this strategy, our benchmark is MSCI ACRI Growth, and in that benchmark, Apple and Microsoft together account for 10%, just two companies. Wow. and we don't own them. Yeah, so there's a challenge. This idea about concentration of companies in benchmarks for us is one very good reason not to pay too much attention to benchmarks, because increasingly they're not telling you about the whole story. They're telling you about a certain part of that story. So we actually don't pay too much attention to benchmarks when we construct this strategy. We think about diversification. We think about the opportunities we're playing into when we think about the risk exposure at the individual company level to within the strategy. But the big only seem to get bigger. We had Alphabet's numbers last night. They were fantastic. The shares were indicating up 9% in the pre-market. This is a company that is going to touch 2 trillion again. So for us, being big has advantages and disadvantages. We don't shy away from investing in big companies, but we do think that there are often more interesting opportunities, and certainly more linked to our thematic, in smaller and mid-cap companies. We have to take each on its own. The fact is that these giant companies, with 1 or 2 exceptions, we all use them. We're using them increasingly, and it's sort of understandable they're getting bigger.
One more question touched up on space. And how do you see that, the privatization of space or space exploration? Is that a growing importance for millennials, for Gen Z? And is that the dynamic that is unfolding?
Well, so I'm really interested that someone's asked that question, because and could we just move to that life cycle chart that we passed over briefly? It's amazing how things that seem to be so far in the future suddenly start appearing. I mentioned that 6 years ago, electric vehicles was a new conversation for many clients. Well, now, I mean, we all know about that stuff. The other area of significant importance for all of us, old and young, is genomics. We are on the edge of an incredible revolution in healthcare that will transform the lives, particularly of younger people, because younger people are likely to live much, much longer than people in my generation. And that brings enormous social challenges. If the average age of a person in this world goes to 120, I mean, think about the challenge for the earth in terms of resources. Think about the challenge for society in terms of pensions and healthcare. I mean, and if you think I'm exaggerating, I've just had a question about space exploration. 2 years ago, no one would have asked me a question about space exploration, but it's happening. We're seeing it in the private space, and it's increasingly talked about in the media. I think being able to invest in a company that is closely linked to space exploration is a long way off from the point of view of feeling comfortable about sustainable returns. I do, but we have to stay open-minded, because the pace of innovation, the acceleration we're seeing in what we can achieve, particularly when things like AI, machine learning, quantum computing, when they start kicking in, things that we thought were impossible are suddenly going to become reality, and space exploration undoubtedly will be part of that eventually. Now, I just wanted to show everyone this page, because in this strategy, we do think about some very futuristic things. We don't necessarily invest in them, but we know that over the life cycle of millennials, which is likely to be a lot longer than the life cycle of previous generations for the reasons I've mentioned, we know that many innovations are going to become relevant, and their growth is likely to be catalyzed by the spending of younger people. The challenges for younger people are no different to the challenges of everybody for forever. You get older, you have a family, you own a property, you need healthcare, you need savings. Those are all the same. But over the life cycle of millennials and Gen Z coming up behind them, we believe that those challenges will be solved differently. because of innovation. And
I have, sorry, just in the interest of time, please.
Yes.
So
yeah,
I have two more questions that I believe are important that just came in.
Okay.
The first being from our colleagues in the industry here in Kuwait, from Thematic Investment.
Okay.
You mentioned about your focus on millennial spending power. How do you see that unfolding in the current scenario with real wage growing below the rate of inflation?
Yeah, so I mentioned earlier that clearly that line isn't a straight line. It's going to be that line of rising income. It's going to be corrugated. There will be periods where income growth is more challenged. There'll be higher unemployment, and inflation, as your questioner quite rightly says, will dent the purchasing power of that income. But there are two aspects to it. Firstly, more millennials will enter the workforce. More millennials will move up the career ladder. They will earn more money. I mean, that is irrefutable. But if you dig a little deeper into that, the other aspect of millennials is that they've been very, very adaptable. You know, most millennials entered the workforce in the global financial crisis. In Western markets, millennials will not be wealthier than their parents for many, many years, possibly never. And it's millennials who have used technology to be able to do things that they couldn't otherwise afford. So, you know, they can't afford an expensive holiday. They use Airbnb. They catalyzed Airbnb. They can't afford a car, so they car share, or they use Uber. You know, my three children, they can all drive. None of them have a car. It's just not part of how they live. So even if millennials go through a tougher time in terms of you know, their economic situation, we think they will find solutions and spend differently to get around that. And those are exactly the sorts of companies that we're thinking about in this strategy.
My kids can't change a tire either, so I guess you're right. And on the final question, you recently added to Chinese ADR. Any concerns with regards to the impact of US and Chinese regulatory risk and the concern of delisting from the US and relisting into Hong Kong? So I believe that's a live concern that we had to address mid last year.
Yes. So of course it is a concern, and it was a major issue last year. We have to be very selective about the businesses we buy, because we obviously want companies that are less vulnerable to regulatory intervention, either because they've been through it already or because they're not in those areas that the authorities are focusing on, and we prefer to own those companies through a Hong Kong listing rather than other types of listings. So yeah, it's a good question. We clearly have to be conscious of that, but I do bring it back to the issue of risk control. You know, no matter how attractive the China market is and China growth and so on, the fact is it has a different risk profile to other markets, and we have to control our exposure there within the strategy.
All right, Richard, thank you. And I think this brings this session into conclusion. So in conclusion, I would like to thank Richard for making himself available for this very insightful engagement. I would also like to extend our gratitude to Goldman Sachs for their continuous and supportive engagement and the relentless effort in sharing the best investment ideas and market intelligence with the regional investment community. It's always a great opportunity for us at Kamco Invest to share with our investors and audience the level of access that we maintain and develop on behalf of our clients and various stakeholders. We're constantly exploring opportunities across asset classes, markets, and niche strategies such as this to deliver the level of risk-adjusted returns that our investors expect from us. Goldman Sachs as a firm and the strategies it offers are a testament to the level of sophistication and quality that we demand on behalf of our clients. This is how we remain competitive across our products and services, regionally and globally. We're consistently ranked among the top performers regionally through our products, and we consistently invest in the best of breed managers and strategies globally. So thank you for joining us, everyone. And we certainly look forward to our next event where we can get the opportunity to share with you our thoughts and ideas. Thank you so much for your time.
Thank you, Faisal. Thank you, everybody. Goodbye.
Cheers. Bye.